Thank you very much. It is really a pleasure to be here. This is just such a fantastic conference, and I am so honored to be the person that kicks things off. In that regard, Olivia asked me to write a paper that kind of basically outlined what's going on with federal debt and what we expect to happen with federal debt as a way of laying groundwork for the discussions we have to come around public pensions, around the markets that support them, and around the household behavior that affects them. So with that in mind, let me go to my first chart. I think people are probably pretty familiar with this chart, but I want to just say this is the problem. This is a chart showing U.S. federal debt relative to GDP, and I've got CBO's projection under current policy here in the dashed line. If you just look at the end of the solid line, that's where we are today, you can really see kind of the starting point for the problem, which is that we're close to 100% of GDP in terms of federal debt, and that is just the highest, it's close to the World War II high. In terms of this series. So we're already at a high level. And then you can see that CBO's projection has us coming up into unprecedented territory in coming decades. So, so I've come to believe that actually this chart here is kind of equally, maybe more concerning. This is showing the federal deficit. And, look at this chart and look at the solid line. You can see that over history, debt has kind of swung up and swung down, but those peaks are during bad crises. So you can see the Great Recession there, and you can see the COVID period. But look at where we are now. Look at the end of the solid line. We are at 5.8% of GDP, and we are in an economy that is close to full employment, so close to a healthy economy. And you can see that already puts us 70% above the historical average. So it's just really hard to argue that we are living within our means. And I really think it speaks to the political challenges of trying to rein this situation in. But you can see that the deficit is expected to increase from here. Now, let me show you how the deficit, this is the same series, I'm just breaking it down into the primary deficit and the net interest costs, because I think that that's an interesting thing to look at. Sometimes people look at this chart and they say, oh, well, there's some good news here. The primary deficit, look, it's kind of stable over the projection period. That is just, the wrong takeaway from this chart. The primary deficit, first of all, remember, it's a flow. It's at a high level, just like the overall deficit is. So that high level is going to continue to push up debt. And those interest costs, remember, those are endogenous. Those are not something that we have a policy lever or a direct policy lever to control. And look at how they snowball, right? I mean, as debt gets higher and higher, the interest costs get higher and higher. And so even if you have some clever idea to push off the date of reckoning, you're still going to be facing over the longer run that snowballing. So, so let's talk about the exogenous driver. I don't think this is a surprise to anyone in this room. The exogenous driver, or the key exogenous driver, is really population aging. This chart breaks out the primary deficit into the three kind of key components I like to look at. But you can see there the Social Security and major healthcare spending. That's what's rising over the projection period by a significant amount. It's 2 to 3 percentage points. So that's going to be exerting upward pressure on the deficit. You can see it's kind of masked because you've got that decline in other non-interest spending. That I'll come back to that in a moment. That's our discretionary spending primarily. I'm not going to say much about tax revenues. The only thing I do want to say is that look at what CBO is building into its projections. I mean, already CBO is assuming that revenues are going to be higher than their historical average. So that gives you, and raising revenues, raising taxes, of course, is never politically easy. So, there's already a tough starting point. Okay, so population aging. I wanted to show you, this is probably also a familiar graph, but I just wanted you to kind of look hard at this graph as well. This is the population the share of the population that's 65 and older. And I want you to see that it continues to rise to a high level, close to 25%. That's a lot of our population to be 65 and older. But, the point here is, sometimes, I hear, particularly when I'm teaching the young people, they say, oh, the pig's going to go through the python, and kind of that the old people are going to kind of, it's going to ease eventually. Not anytime soon. It continues to rise over the next 30 years. So that's my point there. Okay. So what else? So I wanted to go back to kind of the non-aging related spending. So this is kind of the other non-interest spending when you take out Social Security and major healthcare spending. And I just wanted you to look at this chart for a moment, and I wanted you to appreciate kind of the upside risk to deficits. I mean, kind of the risks in the wrong direction. I mean, you can see the decline here that CBO is projecting. And you might say, oh, there's been a decline over history, so that's not so unreasonable. I want to point out that that decline over history, that really is entirely the peace dividend following the Cold War. So, that was something that was good. It kind of it effectively paid for a rise in spending on other social programs. But, appreciate the fact that defense spending now may be on the rise, given that we're coming into what seems to be a more geopolitically dangerous world. The other component, non-defense discretionary spending, I don't have it on here broken out, but it's actually a really interesting series to look at. It is kind of just really flat on average for history at 3 to 4% of GDP. And so, maybe you think, Congress is always saying, oh, there's so much bloat there, we can cut there, but they haven't cut there because there is a lot of kind of important stuff in there. There's, education and infrastructure, and there are risks there too, that climate spending will go up, that, we'll see some crisis that requires more non-defense discretionary spending. And I don't mean this as a knock on CBO. This is purely coming out of the fact that, they're asked to project discretionary spending, and they're projecting under current law. Well, current law is not telling them about discretionary spending, and so this is just using their mechanical formula. But anyway, the takeaway here, I think, is that, there's upside risk in this category. Okay, so, all right, so, the next thing I always get asked is, well, maybe we'll luck out. Those low interest rates we saw in the 2010s, they were a real help, and they were a real help. Actually, it's remarkable if you look at CBO's projections before the financial crisis, and then, we did all the spending during the financial crisis period, and kind of projected interest payments, didn't rise much, like if you compare 2008 to 2018 or 2019, and that's all because we had this unexpected fall in interest rates. And what you're seeing in the 2010s is you're seeing kind of those low nominal interest rates. What you're seeing more recently is the effects of this burst in inflation after the pandemic. But I want to put this chart up here because I would not describe CBO's interest rate forecast as particularly aggressive. I mean, look at the level. It is kind of lower, considerably lower than it was in the early 1990s. So yeah, we're higher than in the kind of late 2010s, but it's not that much higher, and there's not that much of an increase, in a world where we have much, much more public debt. So I don't think it's likely that we're going to be saved by lower interest rates. So kind of next question is, well, maybe we'll luck out because, AI is really exciting, and we're all doing these cool things with ChatGPT, right? So that's going to kind of create all this productivity growth, which is going to raise GDP, and that's going to raise tax revenues, and that's going to kind of really, save us in the end. I would say maybe. CBO did do alternative projections last year where they showed that debt would stabilize at 110% of GDP if annual productivity growth were half a percentage point higher through the 2050s. And I guess the point I want to make here, and half a percentage point doesn't sound like that much. It's not as much as we got, for example, in the late 1990s. So we'll see that period of productivity growth in the late 1990s, that was very short-lived, just a few years. So what I've done in this chart is you can see the productivity growth embedded in CBO's upside scenario. That's the red line there. And the black line is just a 25 lagged moving average, because you need kind of this higher productivity growth for 25 years to realize this scenario. And I just want you to appreciate the fact that there's only one time on this graph that we achieved that, and that was just the 25 years after World War II, which was a pretty unusual period in terms of commercialization of war technologies and big investments in society. I also just want to say, with regard to AI, remember that if we get this burst of productivity growth, probably the wrong way to think about it is kind of everything else in the budget stays the same. We could have massive displacement that requires more social spending. But even if we didn't get that, just say, it's just kind of unevenly spread through skill bias, technical change, where that kind of top of the income distribution is really benefiting. I don't know that it makes sense to assume that kind of the rest of spending, the discretionary spending stays constant relative to GDP, if GDP is 3 times higher because of this productivity growth. Okay, so that's AI. And whoops. All right, so just last few slides. Okay, so first of all, I want to be clear. Solutions are available. It is kind of hard to kind of walk down think tank row in Washington without someone coming out of a think tank and handing you kind of some proposal to solve our problems. And there are a lot of just excellent proposals, and in fact, we're going to hear some kind of really interesting, a really interesting proposal around Social Security in a minute. So it is possible to fix, but I want you to kind of appreciate Congress. They have as yet taken little concrete action, and they can see the same graph that I showed you about deficits, that it's hard to not conclude that we're living beyond our means. And so I just, the point I want to make here is that the constraint is at least as much political as it is technical, and I'll come back again to that in a second. But I want to kind of, before that, I just want to kind of take stock. Where does this leave us? So I think I've already made this case that if the projections are broadly correct, debt continues, federal debt continues rising relative to GDP. This likely implies, for sure, with these gradual economic costs, you get the kind of classic crowding out that economists talk about, kind of reduced capital formation and slower growth. You get the limited fiscal space to respond to shocks. Okay, so those are problematic. But then, of course, the longer this goes on, the greater the risk that investor sentiment shifts, and you see kind of more of a rise in borrowing costs, and kind of, that's kind of, we're getting into fiscal crisis territory, but that would kind of force the faster and less orderly policy adjustment. I want to say there that when you talk to people about this, they say, well, I don't want that bad kind of fiscal crisis. I want the good kind. I want the kind that the UK had in 2022 with Liz Truss, where there was just a little bit of a scare. The Bank of England stepped in and kind of saved the day, stabilizing markets, and kind of that allowed Parliament, time to kind of act and kind of make changes. I just feel like that doesn't, first of all, it's just a risky thing to count on, everything going well in that regard, but I also just don't think our Congress can move like Parliament did in 2022. So I really kind of, that Liz Truss example, I always hear it from people, and I just don't, it makes me really nervous. Okay, so I haven't talked at all about retirement security, but this is kind of the bottom. So now I'm here. This is the bottom line here, which is I just think kind of this is kind of just a big risk for retirement security. Social Security and Medicare, they're just central to the fiscal outlook, as I showed you. So, who knows how we're going to kind of decide to adjust everything to get debt to stabilize. But kind of, I think meaningful fiscal adjustment is almost certainly going to involve changes to these programs. That alone is going to have implications for retirement security. But the point I want to make is that kind of if you wait for the markets to force this upon us, you get these adjustments made under pressure. And they're more likely to be abrupt. They're more likely to be poorly designed. So, I think that's where the real danger is. So kind of acting earlier, that's the right thing to do to kind of allow for a more deliberate, gradual, and better targeted reforms, and to give people more time to prepare. This is actually my last slide, but I feel like I should just sum up. So I think I've showed you, we have a problem when it comes to federal debt. Maybe, the AI gets us out of it, but there's some big cautions there. But other than that, I think, we have to address it. And I do think the political constraints are at least as, large as the technical challenges there. And I don't have the answers. I feel like, if we can do a better job explaining to the public, if the public leans on politicians, that could force change. But other than that, I think economists just need to do some more thinking about the mechanisms that get us there, whether it's the rules or committees or what it is, because I just think the politics are really tough in this example. And I just, last thing, I just implore you not to kind of appeal to people that this Liz Truss moment is going to solve our problems, because I just think it's dangerous thinking. So thank you very much, and I look forward to the next presentation.